Hi, this is Alan Mandel at HTDT Gold, talking to you from our office at 75 Wall Street. Well, today, October 30th, the Fed announced that they're going to keep their bond buying program on an even keel. $85 billion a month, that's up to $3.7 trillion in assets that the Fed keeps buying bonds, mortgage-backed securities, in order to shore up the economy, prevent it from getting weak. But the economy is still weak, fragile, and uneven as measured by various economic reports that have been coming out over the last few weeks. In Europe, credit quality is deteriorating and unemployment still hovers at 12% in some of the EU countries. Now, what does this mean for gold? People ask me, if the economy is so weak, why should gold go up? Well, at the end of the day, gold will go up because inflation is going to come back with a vengeance. There's also some drama about the dollar and politics in the United States, and that will also keep pressure under gold prices and help them go up. Today, gold hit $13.60 an ounce, hit resistance and quickly fell after the Fed announcement. These are just momentary fluctuations in a commodity that's usually pretty volatile. But the support is here at 1,300, and the weight of the evidence suggests higher prices. Now, I mentioned inflation later on, and people say, well, there isn't any inflation, so why should we worry? We should worry a lot. The Fed keeping interest rates low and continuing the buyback program is actually an admission that the economy is so weak, they have to stimulate inflation to try and get things moving again. Now, the consumer price index came out at a rise of just 0.2%, but that's not the whole story. The big picture is that in consumer prices are electronic items and items that you don't purchase every day. How often do you purchase a computer, an iPhone, or a cell phone? Not very often, maybe once a year, once every 3 years, but the things that matter, food, energy, medical costs, education, things that you use every month, every day, are going up. Even packaging is being shrunk. Cereal used to be in a 1-pound box. Now it's in a 14-ounce box, and the price is the same or going higher. Orange juice used to be in a 1-gallon container. Now it's in a 54-gallon container, but the price stays the same or goes higher. That is inflation. You can't mask it any other way. Inflation has to come back with zero interest rates, $3.7 trillion in bond buying, and a $7 trillion government debt. It is going to come back, and it will come back in a spectacular fashion. I could see 20% interest, 20% inflation over the next 10 years. It will probably start next year sometime. Maybe it'll start coming into the statistics in February or March. But once it does, gold and silver are going to start moving much higher than they are now, and there's room for it in everyone's portfolio. I think 15 to 25% of one's liquid investable assets should be in gold and silver. And as the inflation comes back, it's going to eat away at equity prices, which are inflated now because of the bond buying program. The only assets that are being inflated are securities. That's going to come down, and gold and silver will go higher. Okay, that's my report for today. This is Alan Mandel, HTDT Gold. Thank you.